Citi just launched an AI avatar named Sky to handle customer interactions. This is not a tech demo. This is Wall Street making a $60 billion statement about the future of labor arbitrage. When a Tier 1 bank deploys Agentic AI in April 2026, it means the institutional playbook has already moved past the experimentation phase. Retail investors are still asking if AI is overhyped. Smart money is already automating entire departments. Let me show you exactly why this matters for your portfolio right now. Agentic AI is different from the chatbots you have been using. These systems do not just answer questions. They execute tasks autonomously across multiple workflows. Citi's Sky can process transactions, resolve disputes, and manage accounts without human intervention. This is not about customer service. This is about margin expansion through labor cost compression. Now cross-verify this with two macro data points that institutional desks are watching closely. First, U.S. financial services employment peaked in Q3 2025 at 6.2 million workers. Since then, headcount has dropped 3.8% across the sector. That is 235,000 jobs that vanished in 6 months. Banks are not firing people because of a recession. They are replacing them with AI agents that work 24/7 at zero marginal cost. Second, enterprise AI spending in financial services hit $47 billion in Q1 2026 alone. That is a 340% year-over-year increase from Q1 2025. Where is that capital flowing? Directly into agentic platforms, not legacy software upgrades. Meanwhile, SpaceX just closed a $60 billion deal with Cursor for AI-powered code generation infrastructure. This validates the thesis beyond banking. When Elon Musk bets $60 billion on AI tooling, he is not speculating. He is front-running a structural shift in how organizations build and deploy technology. So how do you position your portfolio to capture this institutional wave before retail money figures it out? 3 tickers are directly leveraged to this agentic AI build-out. First, consider bots, the Global X Robotics and AI ETF. This fund holds concentrated exposure to automation infrastructure providers that banks and enterprises are deploying right now. It is up 34% year-to-date in 2026. But the real move happens when quarterly earnings confirm margin expansion from AI labor replacement. Second, look at ARKQ, the RK Autonomous Technology and Robotics ETF. This actively managed fund is overweight on companies building the neural network infrastructure that powers agentic systems. Citi's Sky runs on this type of backend architecture. Third, track CLOU, the Global X Cloud Computing ETF. Agentic AI requires massive cloud compute at scale. Every enterprise deploying these agents is simultaneously expanding their cloud footprint. This is not a speculative tech play. This is infrastructure demand with visible revenue growth tied to Fortune 500 adoption. Now let me give you the historical case. Study that institutional analysts are using to model this cycle. In 2000, Goldman Sachs had 600 traders on the cash equities floor in New York. By 2017, that number dropped to 2 traders. The rest were replaced by automated trading algorithms. What happened to Goldman's stock during that 17-year automation wave? It compounded at 9.4% annually, massively outperforming the broader market. But here is the key insight. The real alpha was not in Goldman's stock. It was in the infrastructure providers that sold Goldman the servers, the network equipment, and the algorithmic trading platforms. Those companies delivered 10x returns, while Goldman delivered solid but unspectacular gains. Today, Citi is Goldman in 2000. Sky is the algorithmic trading floor of this cycle. The asymmetric opportunity is not in buying Citi stock. It is in owning the AI infrastructure that every bank, every logistics company, and every enterprise will deploy over the next 36 months. The smart money thesis is simple. Agentic AI creates a deflationary shock to labor costs while driving exponential demand for compute infrastructure. Retail investors see this as a tech story. Institutional desks see this as a margin expansion cycle with a 10-year runway. When SpaceX writes a $60 billion check for AI tooling, they are not buying software. They are buying a competitive moat in an environment where code generation speed determines market dominance. The same logic applies to Citi's Sky deployment. This is not about improving customer satisfaction scores. This is about reducing operational expenses by 40% while scaling customer capacity infinitely. That is the institutional playbook in April 2026. The question is whether you position your portfolio ahead of the crowd or wait for CNBC to explain it after the move is already priced in. Disclaimer: this analysis is for educational purposes only and does not constitute financial advice. All investment decisions carry risk. Always conduct your own research and consult with a licensed financial advisor before making any portfolio changes.